The Fed got it wrong. They'd like us all to believe that inflation and growth is stable. We're going to show you this might not be the case. The Fed meeting minutes from their last Federal Reserve meeting were released this week, and it's going to show us, in part, economic activity continues to expand at a solid pace. The unemployment rate remains stable and at a low level. Labor market conditions remain strong. Inflation remains somewhat elevated. Overall, economic outlook is uncertain with risks balanced between employment and inflation goals. Overall, they're pretty optimistic. We're going to show you the numbers they're watching. Then we're going to show you some numbers they're not talking about. Here's employment. In the report they mentioned, the unemployment rate edged down to 4.1% in December, while the labor force participation rate was unchanged, and the employment to population ratio moved up slightly. Here's non-farm payrolls. This number was good, 307,000 jobs. Also, the unemployment rate, that's at 4.1%. That's pretty good, lower than last month. They also talk about inflation. Here they said, with regard to the outlook for inflation, participants expected that, under appropriate monetary policy, inflation would continue to move towards the 2% level, although progress could remain uneven. Participants cited various factors as likely to put continuing downward pressure on inflation. Here's a core PCE. This is their favorite number. That's at 2.8%. That looks pretty good. It ticked down from last month. Here's growth. In terms of GDP, the real gross domestic product rose at a solid pace in 2024. That sounds optimistic. Well, last month it was reported 2.3%. That's not so good. Last quarter's number was better at 3.1. The Philly Fed number was released earlier this week. That's at a level of 18. Not as good as last month's 44, but still pretty good. Here's my take. There are other numbers that tell a different story. You see, the economy is very broad-based, and I don't think it's proper to identify it by such a narrow scope as what the Fed does. In other words, other metrics show us inflation is actually hot and growth is cooling. Here's a CPI. It's a different measure of inflation. On a year-over-year basis, that's at 3%. That's the highest rate of inflation since, well, about June of last year. Here are the building permits on a year-over-year basis, down 1.7%. This is a leading indicator to the housing market. Here's another leading indicator of the housing market. Housing starts on a year-over-year basis, down almost 1%. In fact, this is 5 consecutive months of decline on an annual basis for the housing starts. Here's existing home sales. This was a big number and not really that good. This is the volume of sales, 4.08 million. That is a big disappointment after December's number. Here's the median sales price. That's at 397,000. That's the lowest low we've seen going back to March of last year. Here's existing home sales inventory. Now, inventory is low, which is kind of strange considering sales are low. That's at 1.18 million. Here's another measure of inventory. That's the monthly supply. We're only 3.5 months of supply. That means if we were to sell all the existing homes on the market right now, we'd go through that inventory in only 3.5 months. That's actually a really low number. So what's going on with the housing market? Existing home sales really does paint an interesting picture. The number of sales, they're down. The median sales price is also down. And inventory is down. Well, how are all three down together? See, the number of sales is down in part because of low confidence. The median sales price is down because supply is just greater than demand. But wait a second. If supply is greater than the demand, why is inventory also down? Well, that's because of the lock-in effect. Because mortgage rates are still very high, those potential sellers, they don't want to sell. They don't want to roll themselves in a new higher interest rate mortgage. So supply is down. It's just that demand is down a little bit more. Now, the economy is comprised of numerous business sectors and participants, buyers, sellers, producers, consumers. We must analyze it from numerous angles to fully understand its complexity. So I don't think that looking at the core PCE, GDP, and maybe the unemployment rate, gives us a fair, assumption about the market. There's a lot more to look at. Next week on the economic calendar, we do have a lot more to look at. Here's the S&P Case-Shiller Home Price Index. That'll be released on Tuesday. On Thursday, we have durable goods. We also have gross domestic product and pending home sales. And then on Friday, the PCE, the personal consumption expenditure, all very, very big numbers. We hope this has been helpful. We look forward to seeing you back soon.